Welcome to 10 Slides Global, where geopolitics, markets, and global power shifts are explained in just 10 slides. Today's topic: why investors around the world are suddenly moving away from the US dollar, and how hopes for an Iran peace deal may be changing the global financial system. The global financial system may be entering a new phase. As hopes for an Iran peace deal grow, investors are beginning to rethink where money should flow next. The US dollar is weakening, oil markets are reacting, and global confidence is shifting. But is this just a temporary market move, or the beginning of a much bigger financial transformation? For months, global markets feared a larger Middle East conflict. During uncertainty, investors usually rush toward one thing: the US dollar. Why? Because the dollar is still seen as the world's safest financial shelter during crises. But now, new signals suggest tensions with Iran could begin easing, and markets reacted immediately. Investors are slowly moving money out of the dollar and back into stocks, global currencies, and oil-sensitive markets. Less fear often means less demand for the dollar. The Strait of Hormuz may look like a small waterway on the map, but it controls a massive portion of the world's oil transportation. If tensions rise near Iran, global oil prices can spike very fast. That affects shipping, fuel prices, inflation, and even household costs worldwide. But if peace negotiations continue improving, markets believe oil flow could remain stable, and that gives investors confidence again. When global panic rises, investors buy dollars, but when optimism returns, money starts flowing somewhere else: into stocks, into emerging markets, into commodities and foreign currencies. That's exactly what markets are doing now. And as money leaves the dollar, the currency weakens. For Americans, that creates both risks and opportunities. A weaker dollar can help exports, but it can also increase inflation and reduce purchasing power. Oil markets react very quickly to fear. If traders believe war could disrupt supply routes, prices rise almost immediately. Why? Because markets fear shipping delays, supply shortages, and rising insurance costs. But now, investors believe oil transportation may continue normally. That could reduce pressure on fuel prices worldwide. And if oil prices stabilize, airlines, transport companies, factories, and even consumers may benefit. The US dollar becomes strongest when the world feels uncertain. Investors trust American banks, US markets, and government bonds. That trust made the dollar dominant for decades. But when global fear starts fading, investors begin searching for higher returns elsewhere. Money slowly leaves safe assets and moves into riskier opportunities. The big question now is simple: can the dollar remain dominant without global fear supporting it? As the dollar weakens, other currencies often become stronger. That's exactly what happened with the euro. A stronger euro can help Europe attract investment, reduce import costs, and improve financial confidence. But there's also a downside. European exports may become more expensive globally, and that can reduce competitiveness in international trade. This is why currency movements affect far more than just financial markets. They shape the global economy itself. Financial markets don't always wait for reality. Sometimes expectations move faster than actual events. The Iran deal is not fully complete yet, but investors already reacted. Why? Because markets trade on confidence, fear, future expectations, and momentum. This shows how psychology controls global finance. Sometimes one political statement alone can move currencies, impact stock markets, change fuel prices, and even affect retirement savings. A weaker dollar creates both winners and losers inside the American economy. On one side, U.S. exports become cheaper globally. That helps American companies compete in international markets. But there are risks too. Imports become more expensive, inflation pressure can rise again, and consumer spending power may weaken. For normal Americans, that could mean higher prices for electronics, fuel, imported products, and foreign goods. In other words, the weaker dollar may eventually hit everyday wallets. Around the world, many countries are slowly exploring alternatives to dollar dependence. Some nations now want more local currency trade, stronger regional financial systems, and less reliance on the US dollar. Why? Because global conflicts and sanctions expose the risks of depending too heavily on one currency. The dollar is still dominant today, but small cracks may already be appearing in the global financial system, and many governments are preparing for a more multipolar economic future. If global tensions continue easing, investors may continue diversifying away from the dollar. Oil markets could stabilize, and new financial systems may grow faster around the world. But history shows something important. During major global crises, the world still runs back to the dollar for safety. So this may be the biggest question facing global finance today. Is the dollar experiencing only temporary weakness? Or are we witnessing the beginning of a historic financial shift? Thank you for watching. This was 10 Slides Global, where geopolitics, economics, and global power shifts come together in one visual story. Stay informed, stay ahead. And now we want to hear from you. Will the US dollar remain the world's most powerful currency? Or is the global financial system slowly changing forever? Like, share, and follow 10 Slides Global for more deep global explainers.